Okay, welcome to another edition of your cryptocurrency journey. So today I will be talking about what you need to kickstart your cryptocurrency journey, and I'll be giving you tools and insights to what will make you a profitable trader. I'll be giving you insights to the tools that will make you a profitable trader. Now, straight into it. My name is Agbonoga Anthony. I'm a civil servant and an artist. I'm based in Benin City, Nigeria. I'm passionate about spreading the gospel of cryptocurrency, and this is because despite my main job, I can trade and make extra income from cryptocurrency. So I hope that by the end of this webinar, you'll be convinced to start trading as well. So my background is in agricultural economics, and this shows that you don't need to be a computer guru in order for you to start trading. It is very easy and it is open to everyone. So at the end of this webinar, I believe each and every one of us would know how to trade and how to deposit money on your wallets and use it to make trades. Now, in my first video, in the video I first made, I introduced you to what Binance is. So Binance is a platform where you buy and sell your cryptocurrencies. So it is what we call an exchange. So Binance is Binance is an exchange. So it is the world's leading blockchain and cryptocurrency infrastructure provider with a financial product suite that includes the largest digital asset exchange by volume. So it's trusted by millions worldwide. The Binance platform is dedicated to increasing the freedom of money for users and features an unmatched portfolio of crypto products and offerings. So there's more information in the website, and if you're interested, you can head on there and read about Binance. But it is the number one of that pata of them all, the first cryptocurrency exchange that you should be using to make your trades. So now let's go into what this topic is about. Trading. What is trading? So from primary school, secondary school, we already know that trading is just basically buying and selling or exchanging one thing for the other. It can be that you're exchanging your money to get a shoe. It can be that you're exchanging your computer to get another computer. So when those two things have taken place, you have executed a trade. So when it comes to cryptocurrency, it's simply is the same principle. You buy and you sell. So when you buy your groceries at the local shop, that is a trade. When you exchange your old PC for a new game console, that is also a trade. So we can go on with so many examples, but to cut long story short, any activity where you give something to someone in return for something else is a trade. So this principle really extends to the financial market. So cryptocurrency is not exempted from the trading principle. So you trade financial assets like stocks, bonds, forex pairs, options, cryptocurrencies, etc. So you don't need to worry about all of this yet. By the end of this lesson, you should be an expert. Now, you can't place a trade if you don't know what you are looking at. So these diagrams you have here are the things that you will see when you want to place a trade. Now this is a chart. This is a chart that you can see here. This is called a chart, and it shows the price history of a particular asset. It shows what? The price history of a particular asset. So you can see this yellow line here. It simply shows you how the price has moved over a period of time. It shows you how price has traveled over a period of what? Time. So it shows you what? Price history of any asset. What you have here you will have the market pairs here. This is where you have the market pairs, and this is where you select whatever assets you want to trade. This is where you select the pair that you want to trade. So we will deal with that in just a second. Now this, what you have here, is called the order box. The what? Order box. So this is where you buy or sell. This is where you actually click buy or you click on sell. So market pairs and what? Order types. Market pairs and order types. So what is a market and market pair? So when we talk about a specific market, we mean the place where buyers and sellers come together to trade a certain asset. So like you have your let's say Balogun market in Lagos or New Benin market in Benin. It's just basically a place where buyer and seller come together to, you know, carry out whatever they want to carry out. That's just it. So in cryptocurrency as well, you have what you call a market. So this is where people come together to carry out their trades. Now that's for markets. What is a market pair? When we talk about a market pair, we are talking about if we buy something, what are we paying with? And if we sell something, what are we getting? So let's take this market pair, for example. This is Bitcoin and South African Rand. This is Bitcoin, South African Rand. For example, now the Bitcoin South African Rand is a pair in the market, and it says that when you want to buy Bitcoin, you are paying with what? Rand. You are paying with what? Rand. When you want to buy this one, you pay with this, and then when you sell this, you get this back. So the market pair BTC indicates that if I want to buy Bitcoin, I have to pay with what? Rand. And if I want to sell my Bitcoin, I will be paid in Rand. That's just it. As easy as that. So easy, so straightforward. Now the Ethereum Naira pair is the same thing, is, you know, works with the same principle. So this pair simply means I want to buy Ethereum and I will be paying with what? Naira. Then when I sell back this Ethereum, I'll be getting back Naira. This is as easy as that. So that is it for market and market pairs. Now there are different type of orders that you place. There are different types of orders that you place in the market. Diverse types. Now let's deal with the first one. The first one is called limit order. First one is called what? Limit order. And this order goes for both buying and selling. Now the cryptocurrency market is not like any, you know, not like your physical market, not like your grocery store. You know, this market, the things are automated. You know, it's online, so things are automated for you, and things have been made so easy for you to be able to maximize your profits. Now in a limit order, let's say you are eyeing a coin to buy. Let's say you want to buy Bitcoin, but right now the price is too high. The price is too high, but it's not even that the price is too high that's the problem. You actually want to make profits. So you will now say, when this price, let's say Bitcoin is now 10 naira, so now say when this Bitcoin drops from 10 naira to 2 naira, that is where I want to buy. So you can place your limit. You can now place your limit. So it will buy either below that 2 naira or on the point of that 2 naira. It will not go below, it will not go above 2 naira when you want to buy. So that's why it's called a limit. You now place a limit on the amount you want to buy. So when Bitcoin drops to 2 naira, the trade is automatically executed because you have placed it there. So the same thing goes for when you want to sell. Now when you have Bitcoin, when you have now bought that Bitcoin at 2 naira now, and you want to sell it to make your profit, now you feel that the price of Bitcoin will go up. It's going to shoot up in the nearest future. Now what do? you place a sell order using the limit order. Now you can now say, okay, now when Bitcoin gets to 7 naira, sell for me. So when it gets to 7 naira or above, it's going to sell. It is not going to sell below 7 naira, because that is what you have put in there. Even if you put 5.2001 like that, it is going to execute when it gets to that price or above it. So that's it for limit order. Don't worry, I will show you live practical examples for you to get a clearer understanding of what I'm talking about. Now, in limit order, you have the patience to wait. You either have the patience to wait for the price to drop, or you have the patience to wait for the price to go up. That's for limit order. So when you're using limit order, the fees that you be charged are very, very, very small. Now let's go to market order. Let's go to what? Market order. What is market order? Now you know, when you go to the market, so let's say you want to buy meat, and one kilo of meat is, let's say, 500 naira. When you get there, you can either buy at that 500 naira, or you can, if you have the patience, you can haggle and haggle and haggle for the price to go low, then you buy. This is just basically it. So when you go to the market, they tell you the price is 500 naira. You now say, okay, I don't have time, let me just buy it and go. That you have bought it at the market price. So market order means you don't have the patience to wait. You want to buy it at the prevailing market price, at the price that's currently available in the market. So you can't wait. You want to buy immediately. No. So this one, because you are not waiting, because you just want to come to the front and chance everybody, you pay the fee. There's a fee, but it is also very, very small, but not compared to limit order. But the fee is very, very small. It is unbeatable. The fees on Binance are unbeatable. Mark my words. Now stop loss order. So now that we know what limit order and market order are, let's talk about stop loss orders. So you have to be very attentive. So just careful and listen to this stop loss order, because it can be a bit tricky for beginners. So a stop loss order is a type of limit or market order that's only activated when a certain price is reached. So this price is called the stop price. So the purpose of a stop loss order is mainly to limit losses. It's mainly to what? Limit losses. So as the name implies, stop loss. This is actually in place for you to stop whatever losses that you may incur. In trading, you may incur losses, but with all this machinery in place, you are sure to limit your losses. You are sure to cut your losses to the barest minimum. So this is where stop loss comes in. So every trade needs to have an invalidation point, so which is a price level that you should define in advance. So this is a level where you say that your initial idea was wrong, meaning that you should exit the market to prevent further losses. So the invalidation point is where you would typically put your stop loss. Now let's say that Bitcoin you have bought now, you bought that Bitcoin for 2 naira. You bought it for 2 naira and you want to sell it for 5 naira. So because you do not know how the market is going to behave, the price may still drop below that 2 naira that you have it for, or it may go to 5 naira. So for you to cut your losses on both sides, while you are expecting that it should go to 5 naira for you to sell, so don't just have that assurance. Don't have so much assurance in any particular coin that this coin is going to go in the way I've planned it. No, the market will mess you up. The market will do what? Mess you up. So you have to be very careful. Now this is where stop loss comes in. You will now say, okay, I want to sell this now as 5 naira. You can actually impute it there. You can say, I want to sell this thing at 5 naira. But if it comes to, because your price that you bought it for is 2 naira, and let's say you are willing to give the market 50 kobo That means that's what you can sacrifice in case the market goes against you. You can now put your stop loss at 1.5 naira and say, when it gets to 1.5 naira, please pull me out. Because if it doesn't pull you out, it is likely to go even lower than 1.5 naira, and you just lose your money. So that's why you put your stop loss. So just like the name implies, I want my losses to stop at this point. So that's one way you cut your losses. So that is the purpose of stop loss. Don't worry, I will show you practical examples of all what I'm trying to teach. Now let's just see an example. This is it. So like we saw in the slides, this is the charts. This is the Bitcoin Naira pair. Bitcoin Naira pair. So this here, what you have here is called the chart. This is the what? Chart. This is the chart. So do not let all this red and green confuse you. I will show you what it is in just a second. So this is what you call the chart. While this, you have the market pairs. This is where you have the pairs here. While this is where you have your order book. This is where you place your orders. This is where you buy or you sell. This is where you buy or you what? You sell. Why this? What you have here is just the market playing out. So all this red you see here, all this red are people that want to sell, while all this green that you see here are people that are buying. So all these ones are buying, all these ones are selling. Now when the price that somebody wants to sell and the price that somebody wants to buy match, then a trade is what? Executed. Let's say this person wants to buy at 6,387,050 kobo. Now when there's someone that wants to sell at that particular price, that is when a trade is what? Executed. That is when a trade is executed. So this is a chart. Don't forget, this is a market pairs, and this is the order book we have here. This is the order book we have here. So you can, all these things too are also available on the mobile app. The mobile app is simplified and very easy to use. Very easy to use. I can assure you, you will not make mistakes as long as you follow everything I'm teaching right now. So let's now place orders. Let's place a limit order and let's place a market order, and you see what I've been saying. So this is where you can toggle into limit or market. This is limit, this is market, and this is stop limit or stop loss. Stop limit or stop loss. So let's start with limit. Let's start with limit order. Now this is the available amount of naira that I have. This is the available amount of naira that I have. So I have 1,750 naira. And this is the price of Bitcoin right now. The price of Bitcoin is 6,365,686. Now I want to always, so what you always want to do is to buy at a lower price and sell when the price goes up. So now I want to buy at a price that's lower than this. What do? I put in a lower price. Let's say put in a lower price. This is it. So I want to buy at 6,365,000 naira. So what do? I input the total amount of naira I want to use to buy. I put everything. So this is where you can change how much you can use. 75% of your available money, 50%, like that. This way you can change. So it's also available on the app. So let's say I want to use all my money to buy this Bitcoin. I click on buy. Now what's going to happen is going to come and show here. So this is where you have your open orders. This is where you have your what? Open orders. So this order is open right now. So order is what? Open. So whenever price gets to this price I put in here, it is going to buy instantly. It's going to buy instantly. So that is for limits. Now let me show you markets. This is markets. It's very easy and straightforward. So what you just do is come back here, put in the amount of your money you want to use. If it's all of them you want to use, you just do that easily, and you click on what? Buy. So it is going to buy immediately. So you can see I have 0 naira, but I have Bitcoin here. I have Bitcoin here. So this is Bitcoin I have. This is Bitcoin I have. Now let's see what stop limit is. Let's see what stop limit is. So let me come here and place my stop limit. So now I have Bitcoin, and this is the current price of Bitcoin, but I want to sell it when it gets to a higher price. Let's say I want to sell it when it gets to 7 million. 7 million naira. So I want to sell at this price now. 7 million naira. So I'm hoping that you get to this price for me to sell so that I can make profit. But what if it doesn't get to this price? Because it can happen. It can happen. So it can start going below the price you bought it for. So what do? You put in the price that you are willing to exit the market in case it starts going south. So you put in the price 6365683. Now this is the current price that it's selling for. But now I'm willing to risk, or I'm willing to dash the market, let's say 10 naira, or let's say 50 naira now. So minus 50, you have 33 here. Yeah, wow. So sell all of them. So two things will happen. If it gets to this price first, before it falls to this price, it is going to sell. Are you getting me now? So it is going to sell. But if it gets to this price first, that you're willing to risk dash the market some money, it is also going to sell. So you click on sell. So I want to confirm yes. Aha. So this is it here now. This is it here. So I have an open stop loss order. So don't forget, if it gets to this price first that you're hoping for it to get to, so you can make profit, it will sell and you make your profit. But if it doesn't and the market starts doing anyhow, of course you don't want to lose all your money. So what do? You just dash the market small part of your money and you exit the market. So it's better to lose a very minute sum of your money than to lose almost all your money. So that is it. That is it for stop loss. That's it for stop loss. So let's go back to the class. That's for stop loss. Now, people always want to know when to buy and when to sell. So I've been asked sometimes, a couple of times, that when do I know when to buy and when do I know when to sell? So that is where fundamental and technical analysis comes in. So you don't just want to buy anyhow without guidance and sell anyhow without guidance as well. So you need to analyze the market first before you can start trading. So fundamental analysis, now this is looking at the underlying factors that affect an asset's value. For Bitcoin, this includes number of addresses, hash rate, trading volume. Now, when it comes to the markets, the fundamental analysis has to do with things outside the market that can influence the price. Let's say, for example, coronavirus that happened. Coronavirus, nobody expected it, nobody saw it coming. And when it hit, Bitcoin fell massively. It went to about $3,000 plus. It fell massively. So that is one of the underlying factors that affect the market. So it has to do with maybe psychological or emotional effects of people that affect the market. Why technical analysis is just simply using the price history and pattern or trends that emerge and use it to make predictions about the markets. So I will explain this to you, step by step. You don't need to worry yourself. So for beginners, or for traders, I will this is the recommended tool to use. Fundamental analysis analysis is basically used by investors, by people that will be investing for a very long time. That's what fundamental analysis is used for, while this one is mainly used for trading. For trading. So these are the charts that we always see with multiple lines, and by the end of this lesson you will be a technical analysis wizard. So wherever you see TA, it means technical analysis, and if you see FA, it means fundamental analysis. Now, using technical analysis, so these are the main tools that you have. You have candlestick charts. You have what? Candlestick charts. And you also have trend lines, support and resistance. And you have the common technical analysis indicators and how to use them. So will be going through RSI, moving averages, that's moving MA, and then Bollinger Bands. Now, candlestick charts. You see, in every chart you're going to have candlesticks. You're going to have what? Candlesticks. And each candlestick that you see, let's say this red one now that I'm currently pointing at, represents a period of time. Each candlestick represents a period of what? Time. And on each candlestick there are 4 data points that are recorded. Each candlestick records the price that an asset opened at, the highest point it got to, the lowest point it got to, and the price that it closed at. So this is OHLC: open, high, low, and close. So they are also referred to as what? The OHLC values. So just take note of these abbreviations. So the open and close are the first and last recorded price for the given time frame. Now, let's say in a time frame of 24 hours, on the first hour, Bitcoin started trading at let's say 4 naira. Let's say it started trading at 4 naira. That is the first point that it was opened at. So it now went as high as 10 naira, all in the space of that 24 hours. It went as high as what? 10 naira, and it also came down again and went as low as 2 naira. Yeah, bear in mind it opened at 4 naira, so it went as high as what? 10 naira. It went as low as 2 naira, but when that 24 hours completed, it now closed at 7 naira. It now closed at what? 7 naira on the 24th hour. That's for that one day. So on the first hour it opened at 4 naira. On the 24th hour it closed at 7 naira. But before the open and close, before it actually closed, it went very high and it came very low. So that is what a candle is showing you. That's basically what a candle is showing you. I will show you that right now. So this candle, this candle right now, you can see this candle, this green one here. Let me make it bigger so you see very well. So you can see this big green candle here. You can see this candle here. Now this main body is called the candle, while the thing you have underneath, that small line is called the wick, WICK, or the shadow. So it's called the wick or what? Or the shadow. It's called the wick or the shadow. So for this green candle now, for the green candles you have on a chart, it shows that what it's just telling is that price closed at a higher level than where it opened. So price closed at a higher level than where it opened. Why for the red candles? It basically says price closed at a lower level than where it opened. Now let's see this green one here. This green one does not have any wick at all. So its price opened here, for this green candle and closed here. So you can see that's why it's green. But for this red one that you have here, the price opened here and closed here, but you can see there's a wick underneath. So that means price went as low as this point, but it was now reversing back, but now closed here. So this chart you have here is the 1 minute time frame. This is the 1 minute time frame. You can also change it to 1 hour time frame. You can change it to 1 day, 1 week, 1 month, like that. So let's now use an example of the 1 week time frame. What is the 1 week time frame now? So this is the 1 week time frame. So you can see this is a perfect example. This green candle you have here. So below the screen, below the chart, you are going to see the date. You're going to see the date and time, as you can see on this one here. Now on Monday, so you pardon me because okay, let's say the week opens on Sunday. Let's say the week starts on Sunday. Now the market started trading, the price started trading at this point. It went as low as this point. As you can see, the green, the wick there shows that it went as low at this point, and it also went as high as this point. You can see the wick there, but the price was now reversing back. It was now coming back down. So on the 12 midnight of Saturday, the price, or 11:59, so the price stopped here. This is where it's recorded to, and this is where it closed. So the trading closed for this, the price closed here on this week, on this candle for this week. Why for the red? It is the reverse. So the price opened here, went as high as this, came down this low, but now came back up and closed here. But it didn't come back to the point where it opened. So that's it. So there are some candles that you see, the price will open and close at the same point. They will open and close at the same point. I'm trying to get an example of that right now. The price will open and close at the same point. Those are called doji candles, but that's not what we're here for. I can't find it. Okay, you can see an example here. So this one is an example. So you can see the price opened here, went this low, came this high, and closed back here. So there was no profit, there was no loss. There was no profit, there was no loss. So that's your candle. You can see that one there. So they can open and close at the same point. Now that's for your candles. That's for candlesticks. So candlestick charts are one of the most important tools for analyzing financial data. Candlesticks date back to the 17th century Japan, but have been refined in the early 20th century by trading pioneers such as Charles Dow. So candlestick chart analysis is one of the most common ways to look at the Bitcoin market using technical analysis. So the next one you have is what? Trend lines. So trend lines just basically show you how the price have been doing over a period of time. What they do is, a trend line will show you the points where price is likely to bounce back. Likely. You get now? So a trend line will show you where the price of a particular asset is likely to bounce back. So trend lines are a widely used tool by both traders and technical analysts. They are lines that connect certain data points on a chart. Now typically this data is the price, but not in all cases. So some traders may also draw trend lines on technical indicators and oscillators. Now the main idea behind drawing trend lines is to visualize certain aspects of the price action. So this way the traders can identify the overall trend and market structure. And if you can do this, if you can identify market trend and structure, you are likely to place a profitable trade. Now let me show you an example of a trend line. So okay, we have an example here. So you are what you're doing is you're basically connecting different points of price, the highest points or the lowest points. So let's use the lowest point first. Now you see this point here, as well. So you connect them. Let's connect these ones. Take note, you are not breaking any point. It must touch a point. Now this is a trend line. What I've done here is I have succeeded in drawing a trend line. Now take note of something I want to show you now. Just take note of something. You see that the price got here and it went back up here. So you can see that for this trend line that I've drawn now, the price has not gone below the line. Has not gone below the line. So you can see that price got here, went back up, got here again, still went back up to this point, got back here again, and what happened? It went back up. And you can see that if I keep drawing the line, if I extend the line, even this point is not going to go below the line. So this can show you where you can buy and sell. You can just see this is a beautiful trend. We have here. You can see it just keeps going up and up and up and up. So if you draw a trend line here and these points have touched, you can extend the trend line. You can extend it and say, okay, at this point I want to buy. And the price might keep going up, most likely keep going up. You can see let me just draw another trend line here again. So you must take note, there are no fixed returns in trading cryptocurrencies. The market is very volatile, and you need to be able to make sound decisions using this analysis. So let's do another trend line here again. You can see this is a beautiful trend line. The price has not gone below this line. So I'm not going to break any price points. It has to touch the tip of any price points. So that's it here. So if the price breaks this line, the price is likely to fall down. So this will help you make informed decisions when you want to start trading. It's going to help you make informed and educated decisions when you want to start trading. So that is it for a trend line. So let me erase this and start again. So that's a trend line. So as you can see here on this diagram, these points touch this point, but if it goes into the chart, then it is wrong. So the next one we're going to see is support and resistance. But before that, let me show you another example of a trend line. So I've showed you now an upward trend. So there are two sides to the coin in trading crypto. Literally there are two sides to any coin you're trading cryptocurrency. So what I did there. So there are two sides to any coin. It goes up and it also goes down. So let me look for a downtrend that I can use to explain. Okay, there's a trend here. Now you can see this trend, these lines, they touch. These two lines touch here. Now you can see that when price got to this line, what happened? Came back down. When price got to this line, came back down. So when you are trading with trend lines, when you use trend lines, you are likely to make a better decision. You're likely to make a more profitable decision. Now support and resistance. This is this is like the most, this is the simplest term. In fact, when I started trading, these two words are the first words I learned when trading: resistance and support. Resistance and support. So now let's look at what a resistance is. Resistance means a level where price finds a ceiling. A resistance level is an area of significant supply where sellers step in and push the price down. This is very easy to understand. Now, a resistance means a point where price will get to and start dropping. Where price gets to and start what? Dropping. Now let me look for an example. Let me look for an example. Let me look for a sweet example. Okay. We have one here. So let me just use the line to show you. So take note, this is not a trend line. This is how to rule a resistance line now. Aha! You can see this line we have here. This is resistance. It means price will not go above this line here. You can see that when price got to this point, what happened? It reversed, came back down, got back there again. What happened? Came back down, got back there again, came back down, before it now broke the line. So the market cannot go on indefinitely with just one pattern. It is most likely to break a particular trend line or a support or a resistance. So that's the beauty of the market. The market is always likely to break a line. So now this is a resistance. This is at this point, when you go to this point, the supply was so much and the price went down. So people sold more than they bought. So people were selling and selling, and the price went down. Now people bought again, sold, and price got here, came down again. That is what a resistance. So a support is just the reverse of it. Now a support means a level where price finds a floor. Take note, resistance finds a ceiling, support finds a floor. So in other words, a support level is an area of significant demand. So here people are buying more than they are selling. Now this is where buyers step in and push the price up. So in a market, in any coin you are trading at all, what you have is, the higher the demand for that coin, the higher the price will go, and the higher its value will increase. Now when the demand for that coin goes down, what happens? The price goes down and its value goes down. That's what is happening when you have resistance and support. Now let's look for an area of support. Let's look for an area of what? Support. Let's look for an area of support. Okay, come on. Support. Okay, let me just use this one. There are better examples, but to save time, let me just use this one. Now, you can see that there's a level of support here. So you can see that the price came down, it bounced on this floor, went back up, came down, it didn't break the line of this, it didn't break the support line. What happened? It went back up, came back down, it did not break the support line. Again, it went back up. So at this point, people were, when it gets to this point, people start buying and the price goes back up. It falls again, people start buying, and that is how you make your profit. That's how you make your money. That is how you make your money from all these price fluctuations. Now that's for price resistance and support. Let's go to the next one. The TA indicators. Like I said before, technical analysis indicators. technical analysis indicators. So what is an indicator? You know, an indicator just shows you, just like your car indicator, you know, it shows you, just shows you what price is doing. Shows you what price is doing, and it helps you make sound decision. Now the first one is called RSI, or relative strength index. So the relative strength index is an indicator that illustrates whether an asset is overbought or oversold. So when an asset is overbought or oversold, that is where you make your critical decision that will help you make money or lose money. So this RSI is a momentum oscillator that shows the rate at which price changes happen. So this oscillator varies between 0 and 100, and the data is usually displayed on a line chart. Now let me show you what RSI is. I'm going to show you what an RSI is right now. So this is where you look for your indicators. If you want to start trading, you come here on the web page and look for your indicator. Don't worry, before I finish this class, I'm going to show you how you can deposit money and start trading, for those of you that don't know how to deposit. So I'm going to show you how you deposit and start trading. So you come here, look for your indicator. You see arrow, relative. So you're going to just find it here. That's it. So this is your relative strength index, and default setting is placed at 70 and 30. 70 and 30. So as you can see it here. Now when this line you have here, this chart goes above 70, so you can see it here. When RSI is greater than 70, that asset is overbought, and that is where you should most likely sell. Because if you don't sell then and the price drops, you will hold, you will sweat and you hold coin for longer than you thought. Now when the price is below, when RSI is below 30, what can you note from that? You should notice that that asset is oversold, and that is when you are most likely to buy. That is when you should buy, because it is now very cheap and it is most likely to go back up. So as you can see, these two lines here now, this one was overbought. What happened? People sold and sold and sold and sold. It got here and it now became oversold. Now people started buying again and started buying, and the price now went back up. So this is an oscillator. An oscillator, like you know in physics, just something that rotates around the same point. So this just goes up and goes down, just oscillating like that. It just goes down, that's just what it is. So when it gets back up here, it is most likely to be overbought again, and that is when you should sell again and wait for it to come back to being oversold, and you buy again. Just as easy as that. That is that for RSI. So let me just show you that on the live. Let me just show you an example. Now we can see here, this is an example here. So we can see here below this line, below the 30 line, the price went below 30 and it was oversold. So people started buying, and it went back up. That is the one for below. You can see the one for overbought. So people have bought it to an extent that is now overbought, and when it's now overbought, people are now now likely to start selling in mass. So people start selling overbought, and this is where you should sell. This is where you should sell. That is where you should what? Sell. Now the next one we'll be talking about is moving averages. Now this one just shows you what price has done over a period of time. It shows you what price has done over a period of time. Now moving averages smooth out price action. Moving averages smooth out price action and make it easier to spot market trend. Now, as they are based on previous price data, they lack predictive qualities. So in other words, they are lagging indicators. So this moving average, just like you know in mathematics or in any calculation, when you are calculating an average, you take a certain amount of data, you add them up, and you divide it by the number of data present in that entity. So that's just what moving average does. It shows you the average of price over a period of time. And let me show you what that is. So again, we're going to go to where we select our indicator. So moving average, that's it there. Boom, it is in the screen. Now this is the 9-day moving average. As you can see, 9 here. This is the 9-day moving average. So what it does is it takes the price of Bitcoin over a period of 9 days, adds it up, and shows you the average price. So as you can see, the blue line, it is not actually corresponding precisely with the price line. You can see this blue line is not touching this red dot here, this lowest point. Why? Because it is working with averages, so it is not going to touch every point. Now you can also, that's just for the 9-day period. Let's now see what is the 20-day period. So if you use 20-day period, you are going to see that it is going to deviate further from the points. So what this means is because it takes in more amount of data. So because more amount of data is now in the picture, it is going to be smoother. Now let me show you something else. What if it is a 50-day period? Well, you can see it now. It is now smoother. It is now smoother because it is taking in the price of 50 days. You understand now? So it's taking in what the price has been for a period of 50 days and taking the average of that. That's why it's smoother. So if you go even further and change it to, let's say, 100 days, you can see a smoother line. A smoother line. You can see it's just going to show you, because it's showing you the average of price over a period of 100 days. That is a moving average. That is a moving average. The next one is Bollinger Band, and this is my favorite indicator. Now let me just show you an example. Now this indicator is made up of 3 lines or bands, as you can see here in this diagram. You have the upper Bollinger Band, you have the middle Bollinger Band, and you have the lower Bollinger Band. So these bands are then overlaid on a chart along with the price action. So all these bands are they are placed on a chart, on the movement of a chart. So they correspond with the price action. The idea is that as volatility increases or decreases, the distance between these bands changes. So they either expand or they contract. Now let me just show you what all this grammar is talking about. Now let me remove this one and put Bollinger Band. So we're going to search for Bollinger Bands. Now that's it. Now Bollinger is in effect. It's not Bollinger Band. Not Bollinger Band. So this is the upper Bollinger Band. This is the middle Bollinger Band, and this middle one is just the moving average, just like what we just did now. This middle one just shows you the average of price, while this is the lower Bollinger Band. Now in between this top line and the lower line, there's a faint shade. It has like a shaded area, so we're going to just call it a cloud. We're going to call it a what? A cloud. So in this cloud, the way this Bollinger Band works, pay attention, it's very simple, but you can easily miss it. When price gets to, this is just a perfect example. When price breaks or gets to the upper Bollinger Band, what do you notice? It starts falling back down. It starts falling back down. So when this candle break this line, what do you notice? It start coming back into the cloud. So it's like the cloud is trying to bring them back from their extremes. So when they go to the upper extreme or the lower extreme, it's like the middle of the cloud is trying to draw them back inside. Now you can see that here again. There's an example here again. Now this one has broken the lower line. What do you notice? It is going back up. It's going back up. So this is what you will notice in most of the cases. In most times, that's what you are going to notice. So I just want to zoom out now and show you other examples. I want to zoom out now and show you other examples. Aha! So you can see this red one here. Now it went outside the line, outside the lower Bollinger. What do you notice? It went back up inside the cloud. Came back up here. It broke it again. What do you notice? It went back up into the cloud. It broke the upper one. What do you notice? It came back down, went up, broke the lower line. What do you notice? It went back into the cloud. So when you want to trade and you see that this line has broken this upper one, this upper band, what should I do? Don't buy. Don't buy. If you have, you can start selling from there. You can start selling from there. So I just want to look for an example. So people asking about when do I buy, when do I sell? This is how you can make better decision. So if you just go and do try your luck, the market will try your luck with your money. So for this one we have here now, you can see that the price has gone out of the line. It's now coming back into the cloud here. Come back into the cloud here. So you see how Bollinger Bands work. That's just basically how they work. Now we are now getting to the nitty-gritty of it. So we are going to discuss the different types of trading strategies that people use. The different types of trading strategies that people use. Now the first one is called scalping. It's called what? Scalping. So all this grammar that is here, let me just explain it to you, but you can take your time to read it. So what scalping, this strategy is simply buying and selling in very short time frames. As you can see the first line here, you see this scalping takes place across the smallest time frames. The what? Smallest time frames. You can typically execute a trade in less than 1 minute. You can buy and sell in less than 1 minute, in seconds. So scalpers attempt to gain small fluctuations in price. So those small, as you will notice it later on, that the price of any asset changes by the second. Like every second the price is changing. Every second or so the price is changing, always changing, even less than a second. So those small fluctuations, that is where you now trade. Let's say in the next 10 seconds price is going to fluctuate 10 times. So let's say price comes to 1 naira, goes to 3, comes back to 2, like that. So you buy and sell immediately, buy and sell fast. So when you are scalping, what scalpers do is they don't make so much profit from a single trade, but they make small profit from diverse trades, and that is where they now add it up and get their money. So you can see it here. Due to the short time frames, scalp trades often only target a small percentage of profit. So just small money you want to get, but it's not just once. You want to make it maybe 100 times. You can do it as much as possible in a day. So usually less than 1%. That's of profit. So you can see it's very small. Let's say you have 100 naira. 1% of 100 naira is what? 1 naira. And you want to make less than 1 naira in profit. Before you can make 10 naira, you see how many times you have to place a trade. Now, so scalping is a numbers game because you have to do it so many times. So repeated small profits can add up over time. So scalping is by no means a beginner's strategy. So you don't want to try this as a beginner. You don't want to try it as a beginner. So an in-depth understanding of the market, the platform you're trading on, and technical analysis are vital to success when scalping. Now we go to the next one. It's called day trading. So day trading is basically entering and exiting a position in 24 hours. So within 24 hours, within one day, you have entered a position and you have exited. That means you have bought, within that 24 hours you have bought and you have sold and you have made your profit within 24 hours. That is a day trading strategy. Now, day trading involves entering and exiting positions within the same day. So in crypto markets, as you probably noticed, they are not subjected to opening or closing times. Now there is no closing in crypto market. It is on 24/7, Saturday and Sunday. Every day you can trade at any given time. So you can trade around the clock every day of the year. Still, day trading is in the context of cryptocurrency tends to refer to a trading style where the traders enters and exit positions within 24 hours. Now in day trading, you will rely on technical analysis to determine which assets to trade. So because the profit in such a short period can be small, you may opt to trade across a wide range of assets. So because the profit you may realize from one day trade may be small, what do? You enter positions in different markets. So you can say you want to trade Bitcoin, you want to trade Ethereum, you want to trade Ripple, you want to trade let's say one DeFi coin. You can trade any coin, you can trade anything at all. You can trade EOS, trade Ava, trade Cardano, just like that. And when you, at the end of the day, when you now sell all these coins, what do you now get? You now realize a sizable profit. You realize a sizable profit from all of these trades. So that's how you do day trading. So this style is obviously a very active trading strategy. It can be highly profitable, but it carries with it a significant amount of risk. And as such, a day trading is generally better suited to experienced traders. So this trading strategy as well is better suited to experienced traders. So you may be wondering, I've gone through two types of trading strategies and I have not talked about which one you can use. Don't worry. The next one is called swing trading. Now, this swing trading has to do with trading various swings in price. Now, before a price will swing, let me just show you what I'm trying to talk about. So, from here to here is a swing, and it can last for days. It can do what? It can last for days, it can last for weeks or for months before price can go from here and get to this point. While all this up and down, 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 those are the fluctuations that day traders and scalpers use. But as for swing traders, you are going to trade huge swings in price, so like high fluctuations, like over a long time. So you can buy here, sorry, you can sell when the price gets to this point, and wait and wait and wait and wait and wait and wait for days. When the price gets back here, you buy again. So cryptocurrency is not a get rich quick scheme. It's not what you just enter today and say, I want to make millions in 1 week. No, it requires patience, just like any other good thing in your life that you must have achieved. Even as a graduate, what happened? You waited and you worked hard for your degree. The same thing. Any good thing comes with a sacrifice of time. You have to sacrifice your time before you can, realize something sizable. So that is where swing trading comes in for the beginners. So there's a strategy for every person involved in the crypto market. There is a strategy for you to use. even as a beginner. You can practice swing trading. You can just buy a coin that looks undervalued. That looks undervalued. Something like Bitcoin now. If Bitcoin should mistakenly go to $4,000, people are going to jump in and dive in, and in a very short time you're going to see the price go back up, because people know that Bitcoin is actually very valuable, and for you to go back to that price means it's your chance to now buy and keep and wait. So if the price looks like it is not corresponding with the value that you think this particular coin is worth, you buy. So often your goal as a swing trader is to identify an asset that looks undervalued and is likely to increase in value. So what you will now purchase this asset and then sell it when the price rises to generate a profit. Now, or you can also try finding overvalued assets that are likely to decrease in value. Then you could sell some of them at a high price to buy them back for a lower price. Now sometimes you can buy some coins. One new coin can just come out, and you can just come to the market, and everyone will just scatter. What do? You buy it, but you know that this value of this coin is likely to go down very soon, because this coin does not have that value that makes it to be at that price. The correspondence is not there. So what do? When it gets to a high price, you sell it fast, because you know that it will drop quick. So you sell it and you wait for it to go back down, then you buy again. So similarly to how it is with day trading, many swing traders also use what? Technical analysis. However, as their strategy plays out over a long period, fundamental analysis can also be a valuable tool for swing traders. So as it doesn't come with the stress and adrenaline of fast-paced day trading, swing trading can be an ideal strategy for beginners. So this, when you trade with swing trading, you are not tensed, because when you are tensed, you are likely to make mistakes. You're likely to make decisions that will harm you rather than give you profit. So where the former, which is what day trading, is characterized, day trading or scalping. So where they are characterized by what? Rapid decision making and a lot of screen time, because you have to be watching your money as it's going down and coming back up. For the scalpers and day traders, you have to be looking at your money, otherwise your money will. So swing trading allows you to take your time with your trades. Now when it comes to swing trading, you can buy a coin. Let's say the coin is 5 naira, you can buy it and go and sleep. You can just forget about it. Maybe the next 1 week, in next 1 month, next 2 months, you can come back when you now start hearing that coin is doing well. That's when you can now go and start selling. So you can see swing trading is perfectly adapted for beginners. Now I've shown you how you can place a trade with the limit order, with the market order, and also using stop loss. Now let me just run over how you can deposit money into your wallet. Now on the web page, you're going to see something here, wallet. You're going to see wallet here, and also I would encourage you to open your account immediately I end this class. Open your account and start trading now. There's a bonus for new traders who make a deposit and start trading. There's a $5 bonus for you. So you can use that $5 to trade, or do whatever you play with it. It is your money, and also the money you have deposited is also your money. You can use to make trade. So I'll drop a link where you use to register, and once you register, you perform the verification. Very, very easy. Perform your verification. This is where it is. You do your identification, and once you do that, you do it with your BVN. So it's very easy and very straightforward. It doesn't take up to 10 minutes. Do your BVN, and once you're done, you come to your wallet to deposit your money. So wallet, this is it. On your app, you're going to see there. It's very, very easy for you on the app. Everything is just at your fingertips. So this is where it is now. This is your wallet. So what do? You click on deposit. And when you click on deposit, you can either choose the option of depositing crypto or fiat, which is your naira. So when you click on fiat, you're going to see it here, naira. Sometimes it may not show you naira instantly. It may show you maybe euro or yen or anything. So once that is if that's the case, what you do is click on it. You are going to search for your naira, and then what you do, you enter the amount you want to deposit. So you're going to charge a small fee, very a giveaway fee of 150 naira. And when that happens, you're going to click on continue. So when you click on continue, an account number will be generated for you. So most of the time, it is a Wema Bank account. This is a Wema Bank account. And I'm going to see the Binance Holdings Limited. You're going to see it, and then this is the account number. So you can just easily copy this, put it in your bank app, send the money. So once you are sure that you have sent the money, you just click I have made this bank transfer. So you click what? I have made this bank transfer. And when you do that, what happens? The money is going to come and reflect in your wallet. Now, once you click I have made this bank transfer, you are going to be presented with a small timer. The timer is going to be maybe for some seconds, because it takes seconds for the money to reflect in your account. So the timer is going to just count down for seconds, and you're going to see your money in your wallet. It's going to reflect in your fiat wallet or spot wallet. So this is it. It's going to reflect here. It's going to reflect here in your wallet. But on your phone, all of this is consolidated into a small package that you can see everything at a glance. And so that is how you deposit. So if you want to go to the market, if you want to start trading, what you do, just click on trade, come to classic, you're good to go. So that's how you deposit your money. And I've also showed you, so you can rewind and watch this video as much as possible to get a clearer understanding, and also create your Binance account now. The time is now. You don't have to wait for tomorrow. The time is now. Now. Open your Binance account and start trading. Whatever questions you have at all, you can drop in the comment section, and I'll be glad. I'll be very glad. In fact, your questions will make me happy to, that I will know that I've actually passed the message. So if you feel that I've learned something today, let me practice it. You can also be a tutor. You can also teach, like I can also do what I'm doing now, teach people, and you will get paid. You're going to get paid. So if you apply to become a tutor, you can earn up to $500 per class. You can earn up to $500 per class. Also, you can keep in touch. There's a Facebook community, there's a Telegram community as well. You can also follow Binance Africa on Twitter for updates. You can also follow Binance Africa on Twitter for updates. You can also join the Nigerian Telegram community of Binance. Also, you can ask your questions. And I want to plead with you to go to Twitter and tweet about what you have learned from this class. If you have learned anything at all, if it's just one thing you've learned, just go to Twitter and tweet about it. You're going to use the hashtag #MyBinanceClass, and that is how they will know that you are tweeting at them. And also, you're going to tag at Binance Africa on Twitter. So follow them first, then you tag them to your post, to your tweet, and also use the hashtag #MyBinanceClass. Also tag me, your tutor, as well. If I've done a good job, you can also say that. And if you do that, I'll be very, very, very happy. So thank you, and God bless.